Hello everyone, this is Ted Bauman here with your Friday Bauman Daily video. Last week I took a lot of stick, as we say in cricket, from people who disagreed with my interpretation of what's going on in the markets. And today I thought I would respond to some of them, at least those that are not overtly trolling. I always recommend or rather welcome any kind of comment, so don't worry, I'm not going to shut down the comment section. Doesn't bother me in the slightest. You don't go on YouTube or in any public forum these days without expecting a couple of, people who are going to try to pull your strings. So let me just start with a couple of comments that I think caught my attention. One was basically saying that essentially I've missed the overall market going up while I'm pining for people to get out. Quit patting myself on the back. I refuse to adjust my theory. I've been wrong on every prediction I've ever made, caused a lot of investors to lose a amount of money. If you listen to this guy for the last couple of months, sorry for your loss. I feel bad for everyone subscribed to the Bauman letter. They must have lost their shirts listening to Ted, since I've been 100% wrong so far. You incorrectly predicted a crash. You are delusional. Folks, first of all, let me just show you the performance of some of the picks that I have made in the Bauman Daily, in the newsletter that I send out, including a few that actually have come from the Bauman letter and from another portfolio that I manage called the Alpha Stock Alert. Here's the list. As you can see, we've made returns anywhere from 5% over really a couple of days, really, because that's a relatively recent pick, up to 35% in residential construction. And that's basically over the last 6 weeks. Now, sure, you can get higher gains than those in some instances. And effectively, I think a lot of people have made a lot of great gains, actually, by buying cheap and riding the things on the way up. But as we saw yesterday, that can turn on you very quickly. And so I want to address the basic question of what it is I've been saying, since clearly a lot of people either don't get it or don't pay attention to the whole message. The message is simple, folks. This is a sentiment-driven market, right? People believe that no matter what's happening in the real economy, that the Federal Reserve will continue to support the stock market ad infinitum, and that is going to carry on indefinitely, and that so the appropriate thing to do is to buy stocks to try to make as much money as possible. Now, I will admit that I didn't see this rebound coming in the way that it actually has. In fact, I did, on a couple of previous videos, say that I was adjusting my theory, that I was not necessarily sticking with a double bottom prediction, but rather that I was going to be looking at something more like a Nike swoosh. Basically an up followed by a down followed by a long climb back upward. But here's the thing, folks. This is early days yet. A lot of people forget that in 1930, when the stock market collapsed after the October crash, from November that year for another 6 months, there was a bull market run of 50% up from the lows experienced on the 29th. And then what happened? We had a Great Depression. Now, obviously, the policy framework is a lot different now. But the critical thing, and I think this is the key message everybody needs to understand, is that number one, in a sentiment-driven market, it works both ways. Things can turn against you very rapidly. So that's why I've said all along, go ahead, buy stocks. That's what I tell my readers. But make sure you take profits on the way up and that you are ready to turn when the market does. If you just think things are going to keep going up forever, you're being foolish and you're going to lose your shirts. Now, nobody has lost their shirts following my investment recommendations. My Bauman letter portfolio has doubled the market this year, so has the Alpha Stock Alert portfolio. So please, if you're going to criticize my approach, at least do so on the basis of what I'm actually saying, not putting words in my mouth. Now, I don't believe that the economy is sound, and I'm going to show you why now. I'm going to go through a series of charts today. I'm going to start, here's a quote from somebody which wins my award for really the most senseless quote I think I've seen anybody make. This guy says that I have totally discounted the trillions of dollars worth of economic stimulus. Yes, it doubled the Fed's balance sheet, but it's a new injection into the economy nonetheless. People are willing to wait for PEs to come back, Folks, my whole argument has been based on the activities of the Fed and the fact that it is propping up markets in an artificial way. To say that I'm discounting it is simply suggesting that either you're not watching or you're hearing what you want to hear. My point simply is that the Fed can do all it likes to prop up capital markets, equity markets, but it can't restart the real economy. And the notion that this money that the Fed is putting out is going into the real economy, that's absurd. You know that that's not true. This money goes into capital markets. It's not going into business loans. It's not going into anything that is actually stimulating new economic activity. Now, some of that money is being used to leverage other sources of funding to support the real economy through this crisis period. But that's not the same thing as pumping money into the real economy. That, my friends, has to come from Congress. And as you know, Congress right now is basically saying, that, at least the Senate is saying, the Republicans are saying that they are not prepared to support another round of stimulus. The President and the White House are also saying the same thing. So if you think that everything that has happened since April reflects the activities of the Fed and Congress, the stimulus, and if that begins to fade, where are we going next from this, folks? Now, let me show you a couple of charts that show what the Fed has actually done. As you can see, the Fed's balance sheet has increased by the most amount ever in history from the 11th of March this year to the end of May. It has tapered off a bit since then, but that's a dramatic increase. Next chart shows the balance sheet and the 6-month rate of change. Again, the same thing. Massive, massive injection into the economy. So yes, I'm not discounting the Fed, absolutely not. My point simply is that when you artificially inflate the stock market with liquidity, what you're really doing is feeding sentiment. And sentiment is extremely volatile. Sentiment can burn you. So a lot of people are saying, well, this demonstrates that the recovery is real. It's a recovery in a lot of people's heads. And as I'm going to show you, a lot of those people are essentially gamblers. And if you want to be a gambler with your money, that's fine. But that's not what I do, and that's not what I tell people in the Bauman letter to do. Now, on to the question of the jobs report. A lot of people said, well, it shows that there's a very quick recovery coming. I had a guy say, well, how could you say that we should have seen this coming? Well, first of all, I think it's clear now that the jobs that we saw coming back were people who were on temporary furlough who came back. Half the increase in jobs in May was due to the retail sector, the restaurant and retail sector. So basically, a lot of people who had been initially let off came back into the market in order to reopen in the states that have reopened, like here in Georgia. So that's why I said maybe we should have seen that coming, because essentially we knew that if there was going to be a reopening of certain parts of the economy, that we would see some people come into the job market. The question is that a sustainable solution to the jobs problem that we have? And the answer is absolutely not. At the same time that we saw those people coming back to their jobs in the retail and restaurant sector, we saw that 9.89 million people were laid off, quit, retired, or in some way basically left their jobs permanently, which is the second highest figure ever in U.S. history, the highest figure being in March this year. So in March and April, we continue to see massive, massive numbers of people basically leaving their jobs and not coming back. The fact that some of them did come back on a short-term basis, thanks to the Paycheck Protection Program, does that indicate a massive recovery happening? Not in my book, folks. So let's look at a chart that shows total U.S. job openings in the non-farm sector. Right? You can see that basically so far this year, we have seen the steepest drop ever since in the last decade, basically, in the last 2 decades, really. So if you want to call that the signs of a rapid, very quick recovery, please go right ahead. Just be careful what you do with your money if you're going to bet on it. Now, here is another picture that shows you the trend of insurance benefits. It shows basically how much money the U.S. Treasury has pumped into the economy in the form of unemployment benefits in the last couple of weeks and months. What happens when that money ends, folks? It's supposed to end in July. Is that going to sustain the economy? No. So now let's look at the unemployment rate forecast. In February this year, we were at 3.5%. In April, 14.7%. And remember, that includes a misclassification of people who were on temporary layoffs but consider themselves still to be employed, so the real rate would have been closer to 16.5. Now, the current projection is that the rate will decline through the course of the year, and that's perfectly reasonable. However, the Fed came out yesterday and said that that ending rate is probably going to be closer to 9%. I think 9.3 or 9.6 was the figure that they suggested. So even in the last couple of days, we're still looking at 10% unemployment by the end of this year. Now, the key thing here is to look at the structural unemployment rate. That's basically people who cannot get jobs because the kinds of companies, the kinds of businesses they used to work in no longer exist. And that is the problem, folks. You can see short-term gains in job figures in a particular month, but at the end of the day, what matters is the knock-on effect of businesses that close, people that lose their jobs, people that are no longer earning money so they can't spend money. That has a downward spiral effect on the economy. And as an economist, that's what I'm paying attention to. I'm not in here talking just about the sentiment behind the stock market. I'm looking at what's actually happening in the real economy. Now, the other thing to keep in mind is that if you look at the relationship between the US stock market and the rest of the world, here's a chart that shows that at the moment, the ratio between the level of our stock market and the rest of the world is at historical highs. That means that the rest of the world is still being circumspect about the possibility of recovery, but not here in the United States. So I think that's something to consider. We are heavily dependent on international trade, and if the rest of the world is discounting the future, why aren't we? And I think I'm going to show you why in a moment. Lastly, here's a chart that shows total unemployment. Basically, as you can see, that blip upwards in April and May. Great to see, but it's not even close to bringing us back to the number of people actually at work relative to the way it was before. And remember, all those people who have lost those jobs are now essentially not spending money, or they're spending money as little as they can. And in fact, that's driven up the savings rate, which in turn decreases economic activity, which is bad for the economy. Again, this is all the kind of stuff that I look at, not just sentiment. Finally, a graph that shows the percentage of Americans in employment. That's a different way of looking at unemployment. It's basically the number of people out of the total workforce, rather out of the total adult population who are at work. As you can see, we have dropped precipitously from over 60% down to just over 50%. That's a huge drop. Those are all people spending money, and that all means that their future contributions, in other words, the velocity of money, I spend $1, give it to somebody else, they spend it, all those chains of transactions that contribute to GDP, not going to happen, because those people are either not earning money, or whatever unemployment bets that they're getting, they're using for essentials and trying to save some to try to survive. So fundamentally, as an economist, yes, this is not good, folks. And again, yes, maybe I didn't see the dramatic increase in sentiment over the last couple of weeks and months. But as I said, I didn't tell anybody not to buy stocks. I said, be careful, and I continue to say so. Now let's look at what's driving up the market, in my opinion. This year, the share of retail investors in March and April as a percentage of all stock transactions was 40% higher than it was in 2019. A lot of people with their Robinhood apps and their e-trades have been getting into the market. Online brokerages have seen a record number of new accounts opened this year. Now, here's the interesting thing. Robinhood, if you look at the demographic, basically has almost an identical kind of demographic to the people who like to gamble on online sports books. Basically, men aged between about 25 and 35 tend to be the most active participants in sports betting, and since sports hasn't been happening, it's pretty clear that a lot of those people have basically flocked to Robinhood. Now, I'm not just speculating about this. There have been a slew of articles analyzing the kinds of people who are moving into those positions, basically in the stock market, and a lot of them are basically substituting what they used to do in sports with gambling on the stock market. That's fine, and that's driven the stock market up. Great. If you're smart, you get in, you make some gains, just like we've done with the Bauman letter and my alpha stock alert, but you got to get out when the time comes, and nobody knows when it's coming. Now, at the same time, professional investors have sat on the sidelines. $5 trillion, folks, in money market funds. Those are the big guys, the guys who are trying to preserve capital, trying to avoid getting caught in a sudden volatile downdraft in the market. Bond funds, on the other hand, have seen a dramatic increase in the amount of money coming in. Just yesterday, on Thursday, we saw a huge spike in the gold price. We saw a spike in bond yields, or rather a decline in bond yields as people poured into bond markets seeking safety. So again, this shows you that there's a lot of big money that is moving in the opposite direction of the retailers. Now here's a chart that shows sentiment. This is the Citigroup Panic Euphoria model. Right now it is sitting solidly in euphoria territory, significantly higher than it was even at the beginning of this year when nobody knew about the coronavirus. Now again, here's a chart that shows the number of Robinhood user positions rising from just around 4 to 5 million to over 12 million. So a lot of people coming in for the first time. Here's a chart that shows the speculative call positions. Basically, look at that. I mean, it's incredible. Just a massive increase in the number of people betting on call options in the stock market. The next chart shows the relationship between small and large speculators in terms of the volumes of their option orders. As you can see, the smaller speculators are pushing up options. They're buying calls. The large speculators are buying puts. So again, I think this is plenty of evidence that shows that right now we are essentially in a situation where a lot of people who are into gambling are essentially pushing up the stock market. Now again, that doesn't change the fact that the stocks are going up, and great for you if you can ride along with that and be smart enough to get out at the right period. But remember, what you're doing is gambling, and you're gambling essentially with the Fed's money. That's great. But at the end of the day, it can turn on you very quickly. Now, let's look at what some of these gamblers have done in the stock market recently. Here's a list of companies that have gone bankrupt this year. And here are some of the returns over 2-week periods after they have declared bankruptcy. Pier 1, 287%. Let's see, where's one that Hertz, 92%, etc. Folks, when a company goes bankrupt, stockholders don't get any money back. Very, very, very rarely do they. So what are people doing? They are essentially day trading these stocks to try to speculate. But I think partly what's happening is that people don't actually understand what bankruptcy means. They don't know what the laws mean. They just see stocks that are been driven down into the low single digits, and they think, well, a cheap stock, I haven't got much money, so I'm going to buy a cheap stock and see what happens. And it becomes a self-fulfilling prophecy. But here, the second graph shows what happens if you're not careful. Here's a company that is called Fanged Network Group. It's actually a Chinese ADR, but look what happened. People saw the name Fang and thought, oh, well, that's like the Fangs, right? That's like the big tech companies. Let me buy that. They boosted the price up to over $45 a share, and then boom, it all came crashing down again. This is what happened when people who don't know what they're doing are gambling in the stock market, and that is essentially what I think we're seeing happening right now. Now, let's look at the prospects going forward. This chart shows the relationship between a number of different valuation measures to their historical norms going back sometimes really even into the 1920s. All of them except for two, price to 1-year trailing earnings and price to Shiller operating earnings, are in extremely overvalued territory. I've never seen this chart this red. Basically what it means is that relative to the actual performance of the underlying economy and the firms themselves, the stock market is extremely, extremely overvalued. And part of it is because of all this gambling that's going on. Now, here's where the rubber hits the road. This next chart shows you the trend line for real GDP growth. It then shows you the decline in GDP this year. But then it shows you what's probably going to happen going forward. People who talk about a V-shaped recovery think that we get back to the previous trend line. The problem is that we're not going to get back to the trend line. We're going to be under that trend line. We're going to be underproducing. The GDP is going to be lower. People's earnings are going to be lower. Their spending is going to be lower. All of this is going to be lower than it would have been otherwise, which means that the earnings of companies are not going to recover to the levels that they were. Now, you can maintain that we can wait for that to happen. As the commenter earlier said, people are willing to buy the future now. But how far out in the future are you willing to buy? My guess is that people are not actually thinking about allowing earnings to come up and bring down PE ratios. They're just gambling, basically. They're just expecting stocks to go up. And again, sentiment-driven market works both ways. Now, let's talk a little bit about the situation with the government's intervention, because I think that's one of the big issues here. The government has propped up the economy, but it's signaled that it is basically unwilling to do so. And I'm talking about the Republicans in the Senate, in particular Mitch McConnell, saying he does not want to see another big round of stimulus. Look at the number of companies that have requested financial assistance since March. That's incredible. In the Paycheck Protection Program, over 75% of companies have requested that. This is where the bounce back came from, folks. It came from government support for business, particularly the businesses that were able to reopen because they kept their employees thanks to the Paycheck Protection Program. At the same time, the Fed pumped money into bond markets, and this next chart shows you the cumulative inflows into high-yield ETFs. This is basically people buying ETFs of high-yield corporate junk bonds. It's just skyrocketed, folks. And that's because people are betting that the Fed is going to backstop corporate debt markets. The companies may be losing money, their earnings may be non-existent or headed for low earnings over long periods, but people still want to buy their debt because they assume that Big Daddy Fed is going to look after them. Now, as you can see, next chart shows you that U.S. companies have borrowed almost a year's worth of money in the last 5 months. Now, some of that is drawing down their revolving credit lines to ride out the crisis, but a lot of it is simply opportunistic issuance of debt in an environment where the Fed is implicitly subsidizing the entire debt market of the entire economy. Now, here's a final chart I'm going to show about economic activity. It shows people going back to restaurants. Now, as you can see, even though we have had some reopening during the course of May, overall, the number of people going back into restaurants and sitting down and having a meal has declined or remains anywhere between 50 and 80%, and actually 100% in the case of New York. And that tells me that there's another issue here, that even if we do reopen the economy, there are certain sectors that are simply never going to go back to where they are, or at least not until we have a vaccine. Now, I know that some people have said that a vaccine is going to drop suddenly and that's going to solve all of our problems. Well, again, that's a gambler talking. That's not an investor talking. So my fundamental message today, folks, and I'm going to summarize it for you in 4 points. First of all, I've maintained for a long time that the U.S. economy is fundamentally unhealthy. It is riddled with uncompetitive industries. It is over-indebted by a huge amount. It's extremely unequal, and all of those things lead to depressed consumer demand, depressed spending, which keeps our growth rates low, which has been the case over the last 20 years. And in that context, the Fed's activities have encouraged a situation where equity and debt markets are essentially divorced from the reality of the actual underlying economy. Now that's fine, but it's like a stack of Jenga blocks, right? So you can play Jenga, but you got to know at what point the thing is about to come crashing down. And that's really what I've been saying all along. People who said stay out of the market, that's not what I've been saying. I have been saying be careful. Buy the value companies. Look for companies that have strong balance sheets. Look for companies in essential industries. Because if you just buy on the basis of sentiment and follow the herd going around, you're likely to get burnt. And I still believe that that is the case. Finally, I think the critical thing to remember is that the stock market is a place for investors. If you want to gamble, fine, gamble. But then remember, that's not what most sensible investors can afford to do, particularly people with their retirement savings. So all you guys out there who are on Robinhood and having a great time with your gains, congratulations. I applaud you. But remember, don't blame me if you decided not to do that. That was a decision that people made on their own. And I think at the end of the day, yes, maybe you mixed out some short-term gains, but I have a strong feeling that some people who made those big gains over the last couple of months are going to get themselves extremely burnt, especially if they don't have stop losses set on those accounts. Anyway, that's enough for me this week. I'll be back next week with another commentary. Who knows what the week's going to bring, but I will be sure to give you my unvarnished opinion when the time comes next week. Anyway, take care.